Hey everybody, welcome into Mining Stock Daily. We're going to get some technical analysis on a number of different entities here on a very volatile day in the markets. News came out that Moody's is looking to downgrade, I think I saw 10 different U.S. banks. This is on top of Fitch downgrading U.S. debt from AAA to AA+. I gotta admit that news item was something that I thought was important, but wasn't necessarily a huge market mover by any means. But we're seeing something, I guess, I don't know if this is contagion, but it is some follow through here. And so markets are falling, including precious metals with the big boards. And we're going to talk a little bit about U.S. debt and bond yields. Welcoming in a new guest from Northstar Bad Charts. His name's Kevin Wadsworth. He puts up some incredible TA looks and things he's studying in his charts on his Twitter account. But first, Kevin, thanks so much for joining us.
Thanks for inviting me on, Trevor. It's nice to meet you.
Yeah, it's nice to meet you too. I think it's important before we kind of get into a few of these things. I'm fascinated how you are a meteorologist by trade, but meteorology is a lot like forecasting, which is simply what you tend to do with technical analysis. So you must have found a linkage there.
That's exactly the link there, Trevor. Yeah, I've had 34 years as a meteorologist, and as you say, forecasting the future for customers like, for example, the Royal Air Force and for emergency responders here in the UK. And it was my job to basically predict what was going to happen over the next few hours, the next few days, in terms of severe weather, helping to allow the Royal Air Force to complete their missions and to allow the emergency response community to react during life-critical situations such as flooding and wildfire events and that kind of thing. So a lot of what I was doing was around risk analysis and weighing up probabilities of what might happen in terms of meteorology over the next few days. And I did find a link there, and I started to wonder if it was possible to predict stocks and shares and gold and silver and all that kind of thing using the same sort of methodology. And really, it's a case of evidence gathering in a scientific fashion, and you gather all of the evidence from a technical chart and from trend and momentum and all that kind of thing, bring it all together. And what you end up with, really, it's like a weather forecast. And what it allows you to do is it allows you to weigh up the probabilities of, for example, whether gold is going to go up, down, or sideways. And it allows you to assign a range of probabilities to those possible future outcomes. And by doing that, you can weight your trades accordingly and stand a far better chance of succeeding.
Well, let's talk about the forecast ahead in the economy here, what we're seeing with precious metals and also with debt. And how does the forecast look like for global economies right now, Kevin, based on what you're saying?
Yeah, well, you don't need to be a meteorologist or a brain surgeon to realise that the economy has some serious issues, and I can illustrate that with a chart for you if you like, and I'll just
please do.
Take a moment to see if I can share the screen. So give me a moment to do that. Make sure I'm sharing the correct screen because I've got three here in front of me. So I'll just do that. Okay, so with a little bit of luck there, what you're seeing is the 10-year yield chart, Trevor. Can you see that? Okay, just want to
yeah, we can see that. And just for podcasts and listeners of the podcast, and maybe not be seeing this, we will put it up on the YouTube channel. But yeah, we're taking a look at the 10-year yield right now, and really, this bond yields have been kind of the center focal point of what could happen. Talking about forecasting, Kevin, I see both bear and bullish cases. I'm yet to make an opinion, but maybe you can help form my opinion.
Okay, well, I'll tell you something, Trevor. I started looking at this chart back in around about 2018, 2019. And from a technical analysis point of view, it's very, very striking. And it's clearly been one of the most important charts of the last several years, along with the US dollar index and one or two others. But you can see straight away a couple of things jumped out at me. And one was that throughout the last 40 years, since 1981, the entire move for the US 10-year yield has been controlled and contained by a single line, this red line that's running along the top of the chart here. I'll get rid of the moving averages so you're not distracted by those because they can get in the way a little bit. and I'll also take off the Ichimoku cloud indicator, which we don't need. So you can see this red line that has contained the price action for over 40 years. Now, what happened in 2019 was that we saw a break below what had been the support zone. Now, in 2019, I put out a tweet, and in early 2020, I put out a tweet saying that this was a false breakdown. And from a technical analysis point of view, I made that conclusion for a number of reasons. It's because this is a bullish technical chart pattern that will resolve to the upside. Now, a move and a break to the downside is almost always a false move. And when we got this candle here with a very large wick on the end of it, it made it absolutely clear to me that there was going to be a huge release of energy and that the 10-year yield was not just going to reach the top line again, but break out. I've labeled it the pain line, and you probably noticed that and wondering why has he called it the pain line. Well, if you think about it for a moment from a fundamental point of view, what this line, the reason this red line is in existence is because the 10-year yield cannot reasonably go above it without causing pain. It's because, just think for a second, why has the 10-year yield fallen throughout that entire period? And it all comes down to debt. Debt has gone up and up and up and up in a parabolic fashion. And if debt is rising in a parabolic fashion, then the interest repayments on that debt need to be contained. And it was the pain line that was containing it. It was the pain line was simply a manifestation of the simple fundamental fact that each time the 10-year yield got to that point, the pain became sufficient, and it became obvious enough that the 10-year yield was required to drop. Interest rates and bond yields were dropping throughout this entire period. And as we know, interest rates dropped down to roughly zero at one point, right, which clearly it can't stay down. Everybody was saying the same thing. It can't stay there forever. But I think people generally were thinking, well, okay, so it can't stay down at 0% or minus 1% for very long, but chances are we're going to stay at 1 or 2% because, that's what we've become accustomed to. That's just the world we're living in. Well, the chart said otherwise, and the chart was right. The technical chart was right. We've broken out, and all the pain that you're starting to see in the wider economy now that's sort of rippling out through all of the markets is as a direct result of having crossed this threshold. And we're now in a new investing era. We are in a completely new paradigm here, and it's more comparable to the 1970s, which is the last time we crossed a pain line and moved up and up and up and up. And anyone that was around in the 1970s will remember that interest rates, mortgages, bond yields all went up in unison. And there's one other thing, of course, that went up in unison: precious metals. Gold, of course, had its biggest bull run ever between 1970 and 1980, and commodities as well, oil, of course. And if commodities, oil, precious metals, and rising yields is sort of ringing a bit of a bell with your audience, then so it should do, because that's the environment we find ourselves in now. Of course, there's a crucial difference, and that's the debt to GDP, because debt to GDP was falling from 70% to 31% during the 1970s. And over the last 40 years, debt to GDP has risen from 31% to 129%. So it's kind of like the 1970s, but with some very important, very subtle, well, not very subtle, actually, very important and very big differences and very big changes. So I'm certainly spending a lot of my time at the moment just wrapping my head around all the interrelationships between bond yields, debt, debt to GDP, and also putting all of that in context of inflation over the last 40 years. Right. Because, whether bond yields are outperforming inflation or outperforming gold is also a very important part of that equation.
Yeah. What's interesting here is, the 10-year yield crossed that pain line back in April. And that was about the same time, if I'm not mistaken, where the first kind of banking crisis with the regional banks kind of hit. If I'm thinking back, then that's when the SVB news kind of hit. Now we're obviously higher there, but we've also got a downgrade in 10 banks from Moody's as we move higher. I mean, I guess I'm not quite certain here. At one point I get the bearish case on bonds based on this chart because you just put this arrow upward and it seems like the thrust is upward. However, we don't have necessarily, we have a big Fed intervention clause here, that Fed put that could certainly come into play any time. How do you kind of balance that out? I guess what I'm saying here personally, Kevin, is that I'm still not. I still don't have my own opinion yet of whether I'm bearish or bullish bonds, based on what you're
Well,
saying.
that's where the charts come in, and the charts can clarify that because from a fundamental point of view, there's arguments to be had on both sides of the both sides of the argument. But when
Right.
you look at charts like Bank of America, and I pointed this out several months ago, and you could pick a number of large banking organizations here, but I'm looking at Bank of America because it's a very clean, clear technical chart. And you can see what happened in 2007 from a technical point of view is that the share price for Bank of America in 2007 broke below its support line, broke below
Mm-hmm.
key moving averages, and then it broke down below this green thing that you can see on the chart. It's called the Ichimoku cloud, and it projects future support and resistance. So what I'm trying to say is that we had a very clear series of technical pieces of evidence, scientific pieces of evidence that took place here that told us that the banking sector was in trouble. Now, fast forward to more recent times, what you'll see is that after that huge drop during the banking crisis 2008, what has happened since then? Well, we formed another unpleasant pattern from a technical point of view, and this is called a bearish rising wedge. Now, bearish rising wedges get their name because when they eventually resolve, they nearly always resolve to the downside. And I have to say nearly always because it's always the case with technical analysis and predicting the future that we're looking at probabilities, not certainties. So if you ever hear a technical analyst say, this will definitely happen or that will definitely happen, then in my view, as an experienced forecaster, you should not listen to them. Just the same as a meteorologist or weather forecaster saying that you're definitely going to get a thunderstorm hitting your town tomorrow. Anyone that says that doesn't understand the dynamics of how thunderstorms form in the first place. So it's the same with a technical pattern breakdown. You can look at the evidence and you can say, well, the evidence is pointing to the fact that this pattern is going to resolve to the downside, and the probabilities are 70, 80%, 90%, something like that. And if you're using that kind of terminology, then you're doing it scientifically. If you're saying, well, this is going to happen, this is definitely going to happen, then you're not doing it right, and you don't understand the science of predicting the future, basically. But what has happened here is this bearish rising wedge has actually broken down now. We've got a confirmed breakdown, and we are still above the 3-year moving average, and we're still just hanging on to the quarterly Ichimoku cloud here, which is this red and green cloud-shaped pattern. But if the price just edges down a little bit further, we'll get more technical evidence that this new breakdown is going to develop into something much more serious. So whilst we have got a technical breakdown, and in fact, if we zoom in on the monthly chart, what you can see is happening is a back test. These are now the monthly candles on this chart. So we've broken down, we've gone down below the monthly Ichimoku cloud, and we've back tested the breakdown. Now that is straight out of a textbook. If you read a textbook on technical chart analysis, it'll explain that when you get a breakdown like this, very often price comes back, confirms that breakdown, it confirms the importance of that support line, and then the real bad stuff begins to unfold. So what I would say is that technical chart is pointing to a very unpleasant outcome for not just Bank of America, but the banking sector more generally, and the risk is high. Can this save itself? Can the banking sector turn around? Can financials recover? Then, well, yes, of course they can, but we need to see the technical evidence to prove that, and that would involve the price getting above around about $34 for Bank of America, and equivalent charts are showing the same sort of thing across the rest of the banking sector. But putting these pieces of the jigsaw puzzle together, the 10-year yield, debt. I haven't shown you the debt chart. I might as well do that just for.
Yeah, let's see the debt chart because I can. This sounds like a jungle of a chart.
Yeah, it's not great. It's not pretty at all. If you just give me a moment, I'll try and do that for you. Let me just share the screen and share that particular chart. But you put all these pieces of the jigsaw puzzle together, and you start to develop a clearer picture of what's going on more broadly. So this is US government debt, and probably I think most people will realize what a parabola is. And from a scientific point of view, I'll just quickly explain what a parabola is. A parabolic curve or a parabola is where the price starts low. It doesn't have to be at zero, it can start anywhere. But what happens is the curve begins to get steeper and steeper and steeper and steeper, so that the time taken to achieve a move upwards of, let's say, 10% gets shorter and shorter and shorter. So you're achieving the same growth in an ever shortening period of time. So it might take you, well, as you can see on this chart here, actually, I can show you that if I put a measuring tool on here, you can see just how long it took to gain a move of, say, 100%. It took from there to there. It probably took about 10 years to move up 100%. But more recently, a move of 100% has taken, well, I've already gone up 50% in just 4 years. So the accumulation of debt along this bottom portion of the graph is much slower than it is during this upper portion of the graph. And just visually, you can see that the graph is moving now in a vertical fashion. Now, the debt to GDP is important because down here, the debt to GDP was only 40%. It's 60%, 100%, 130%. So GDP is getting massively outstripped by the rising debt, which feeds back into the whole economic equation when it comes to debt sustainability, because higher debt is fine if your GDP is rising. And we saw that in the 1970s, of course. Debt was rising or perhaps I should say debt to GDP was not rising in the fashion that it is now. In fact, debt to GDP was falling. And of course, if you cast your mind back to the 1950s, 60s, and 70s, the United States had a very strong industrial sector. Of course, a lot of that industry has been offshored to other countries, and so that whole dynamic has changed. So debt to GDP, as I say, has risen by a huge amount, whilst the debt itself has risen. So that raises questions over debt sustainability and debt repayment. And in fact, if I was to show you the chart of debt monthly or annual debt obligations and repayments, it's doing the exact same thing. With interest rates having risen from 1% to 2% to 3% to 4% and so on, then of course, with rising debt, your interest payments go up as well. Right. So to get back to the beginning of the story, which is really, right back to where we started, this all feeds into one big jigsaw puzzle and one big problem and one big end of the track, I suppose you could call it, for the US dollar as it stands at the moment. It's running into the end game scenario, and people have been talking about this for 10, 20, 30 years, the end game. And what are the answers to resolve this? You either grow your way out of this problem by increasing GDP really substantially, or you print your way out of this problem by adding zeros to your currency. And I think it's probably true to say that the most likely outcome is inflating away the debt, which brings with it a whole load of sort of seemingly insurmountable problems, particularly when you're holding the position of the global reserve currency. It's not like a small unimportant country, if you want to call it small unimportant country, Zimbabwe or whatever. One individual country in isolation going through a hyperinflationary crisis is one thing. But if it's a large economy, say, I don't know, Germany or one of the Eurozone countries, then that will be far more important and far more systemically important as far as global finance is concerned. So the bigger the domino, the more important it is, the more dangerous it is when it falls over. So the United States, in the position that it's in, having this seemingly insurmountable problem is going to be a destabilizing threat to the entire global community. Perhaps, maybe, I hope, the the bankers and the politicians and everyone in charge of what's going on has got some sort of grand master plan to bring in a digital currency and completely circumvent the issues that we're facing. But as it stands right now, the mathematics of it just doesn't really add up.
All right, Kevin. So let's spend a couple quick minutes, if we can, talking about precious metals, because obviously silver and gold fit into this jigsaw that you've painted a pretty ugly picture of, I must say, on the with the charts previously. But what are you looking at with gold and silver here? Because they're both in pretty interesting positions here in their own charts, respectively.
Yeah, sure. Well, the gold chart is playing out pretty much in line with expectations. So what I mean by that is that the large cup and handle pattern in gold is progressing well. This is my gold roadmap chart. It's a 12-year cup and handle pattern, and the arc that contained the price for the entire period from 2011 to 2021, so 10 years, completed, and the arc target was reached. Anybody who follows me on social media will know that in 2019, I put out a forecast that said that gold would move back to the previous highs and then consolidate for an unknown period of time at that time. So all I was focused on in 2019 was the move back to the previous highs within the arc and then a handle on the arc. Now, once the target was hit, we were able to start drawing the handle on the arc. It's taken a lot longer than many people anticipated, but because we have technical analysis on our side, having hit the target and started the pullback, we've been out of gold until we get the breakout in terms of trading. Now, there's two very different ways of approaching precious metals. Of course, one is stacking and one is trading. If you're a precious metal stacker, then you'd be absolutely overjoyed that you've had this extended period of time to accumulate gold below $2,000 and to accumulate silver below $25. But I suspect that the opportunity or the window of opportunity is close to closing as far as that's concerned. Why do I say that? Well, because on the monthly and the weekly chart, gold has broken out of its handle and is it currently in the process of back testing that handle. The price can fall to around about 1900 to 1905 without violating that breakout. So what I'm saying is that I would expect price to hold on a monthly closing basis above the 1900 to 1905 level and then begin its journey upwards. And there are a number of ways of estimating an initial target for the gold price. And I think a reasonable one is anywhere around the mid 2000s, 2400 to maybe 2800. The round number obviously is $3,000 that I think probably quite a lot of people are going to be focused on. But we can track the distance from the 3-year moving average as this rally develops, when the rally develops. And by tracking the distance from the 3-year moving average, we can estimate when the gold price is getting overheated and due for its next pullback. Now, 2024 is, or late 2024, I should say, is when I would expect a little bit of an issue with the markets. A lot of the charts are pointing to some kind of pause, pullback, maybe event later next year. And I'm aware of the US elections in November of next year, and that could well play into this. So my initial expectation is for an upside move into the mid 2000s, a pullback, and then much higher values beyond that. Not really going to focus too much on that at the moment, but as long as this 1900 level holds, that's my roadmap forecast. If 1900 doesn't hold, then the 3-year moving average will be tested, and currently the three-year moving average is sitting at 1832, 1833. So we could get down to that level if the handle support does not hold. So we have to stay open-minded. We have to remain completely unbiased with this. If you're a trader, you probably wouldn't want to get in until you get a monthly close above around about the 1980 to 1990 level. And at that point, as a trader, you'd be able to trade the what would by then be a clear move up into the mid 2000s, perhaps a little bit higher towards the upper 2000s. But stackers will, as I say, be enjoying this period. In terms of silver, I'll just
Hey, Kevin, maybe instead of just for time's sake, let's not open up the specific silver chart. But I know you do have that silver to gold ratio
yeah.
that I think might be worthwhile. Let's just stick with that, and we'll come back to this because I think there's going to be a little bit of clarification here of where the metals are heading. But let's talk about that ratio here, and then we'll wrap it up.
Yep. Okay, so the gold-silver ratio, very important for precious metals investors, of course. And what is that chart telling us? Well, I'll show you what it's telling us.
It's getting squeezed.
We've got we've declined and fallen a long way from the 126 ratio for gold to silver. So at that point, 126 ounces of silver to an ounce of gold, and we're all the way down. It's around about 84 at the moment. And in so doing, we've created a number of technical chart patterns that we've been able to take advantage of. And we now have a very clear resistance line. We have a very clear key support line, which actually forms part of a bearish rising expanding wedge. You see the rising line there and the support line here. So this red segment that we're in at the moment is where we've been expecting the price or the ratio to bounce around as long as it likes, really, all the way up until the early part of next year. And it's going to break down below the key support line at some point, I think, according to the sort of probabilistic analysis. So the most likely resolution of this pattern is a downside break with the gold-silver ratio dropping in the context of a precious metals bull market. If this breaks to the upside, then it would suggest to me that there is perhaps some kind of event taking place, some kind of credit event, a financial crisis, a banking crisis, which would perhaps take all assets down initially. And were that to happen, I would expect it to be a false break to the upside and then a resolution to the downside as that liquidity event subsides. So I think to summarize, we expect the gold-silver ratio to move down. So we expect silver to outperform gold in the context of a precious metals bull market developing over the next few months. But that is only threatened by a financial event, market event, that would lead to a search for liquidity, a liquidity crisis. And if that were to happen, then of course everything would get thrown out of the window initially.
Kevin, you've given us a lot of food for thought here, and I think maybe it's best you and I should touch base again next month and see how some of these charts have come into fruition here, because I think the next couple of weeks are going to be very interesting to watch here, because obviously very volatile 2 weeks, and there's probably some more moves and downside ready to go, at least in the market side. So can we do that? Maybe touch base in September and see how some of the stuff plays out.
Yeah, I'd be very happy to do that, Trevor.
Yeah, I mean, lots of interesting technical analysis there, and I appreciate it. I'm glad we did this. Kevin, before we let you go, tell us where people can follow you and find your work.
Yeah, well, I'm at Northstar Charts on Twitter, and if you like what you see on social media feed, we've got a website, and that's northstarbadcharts.com. Myself and my friend and business partner, Patrick Karim, northstarbadcharts.com, and we carry out all this technical chart analysis across all the markets, particularly, of course, being advocates of sound money with gold, silver, and cryptocurrencies. So, yeah, that's where you'll find us.
All right. Thanks, Kevin. Have yourself a good rest of your day.
Okay, you too, Trevor. Bye for now.